Strategy number 1, real estate leverage. You think you need $500,000 to buy a $500,000 property. Rich people know they only need $100,000. That's leverage, and it's how they multiply returns while you're saving up to buy things outright. Here's what's actually happening. They put down 20%, $100,000, and borrow the other $400,000. The property appreciates 5% in a year. That's $25,000 in value gained. But here's the part nobody tells you. That $25,000 gain happened on a $100,000 investment, not a $500,000 investment. That's a 25% return, not 5%. They turned 5% appreciation into a 25% return using the bank's money. You're saving up to buy the whole property in cash because you think debt is bad. By the time you save $500,000, that same property costs $650,000, and you've missed years of appreciation. They control 5 properties with $500,000. You control 1. Their properties appreciate $125,000 total in a year. Yours appreciates $25,000. Same capital, 5 times the return. That's not luck. That's understanding leverage. Debt isn't the problem. How you use it is. They use it to control assets that appreciate. You use it to buy liabilities that depreciate. Strategy number 2, business financing with other people's money. You want to start a business. You save up $50,000 of your own money to fund it. You think that's responsible? Rich people don't use their own money. They use other people's money. Here's what's actually happening. They raise $50,000 from investors or borrow it from a bank. The business succeeds and generates $200,000 in profit. They own 100% of a business they funded with 0 personal capital. You put in $50,000 of your savings. Your business also generates $200,000 in profit, but you risked your personal wealth to do it. If the business fails, they lose other people's money. You lose your life savings. If it succeeds, they built wealth without risking personal capital. You built wealth, but took all the risk. And here's where it gets better for them. That $50,000 you used, they invested it in the stock market instead. While their business grew, their invested capital also grew. They're compounding in 2 places at once. You're compounding in 1. Rich people understand that the best use of their capital is often not their own business. Use debt and other people's money for the business. Use your capital for investments that compound passively. You're doing the opposite. That's why they're winning. Strategy number 3, tax arbitrage. You have $100,000. You owe $100,000 on your mortgage at 4% interest. You're trying to pay it off early because you hate debt. Rich people keep the mortgage and invest the $100,000 instead. Here's what nobody tells you. Mortgage interest is tax deductible. Investment gains are taxable, but they grow tax deferred until you sell. If you pay off the mortgage, you save 4% interest. But you lose the tax deduction, so your real savings is closer to 3% after tax. If they invest that $100,000 at 8% average annual return, they're making 8% while paying 3% net cost on the mortgage. That's a 5% arbitrage. Over 20 years, that 5% difference turns $100,000 into an extra $165,000. You paid off your mortgage and saved $80,000 in interest. They kept the mortgage, paid $80,000 in interest, but grew their investment to $466,000. Net difference after paying off the mortgage? $386,000 versus your $180,000. But here's the problem with your approach. You feel safer. You own your home outright. They're wealthier. Financial safety and financial wealth are not the same thing. You optimized for feelings. They optimized for math. Strategy number 4, rate arbitrage. You get a loan offer at 3% interest. You decline it because you don't want to be in debt. Rich people take every low-interest loan they can get, then invest the money at higher returns. They borrow $500,000 at 3%. They invest it in assets returning 10% annually. You're keeping your money in savings earning 0.5% because it's safe. Inflation is 3%. Your savings is losing 2.5% of purchasing power every year. Their borrowed money costs them 0% after inflation. 3% loan minus 3% inflation equals 0% real cost, while earning them 7% real return, 10% return, minus 3% inflation. They're getting paid to borrow money. You're paying to save it. And here's where it compounds. After 10 years, their $500,000 borrowed and invested becomes $1.3 million. After paying back the loan and interest, they clear $650,000 in profit using money that wasn't theirs. Your $500,000 in savings? It's worth $525,000 after 10 years at 0.5% interest, but inflation ate it down to $430,000 in real purchasing power. You lost money being safe. They made $650,000 being strategic. Strategy number 5. Margin loans against portfolios. You need $200,000 for an investment opportunity. You have $2 million in stocks. You sell $200,000 worth, pay capital gains tax, and invest the rest. Rich people don't sell. They borrow against their portfolio. You can borrow up to 50% of your portfolio value at 2 to 4% interest. They borrow $200,000 against their $2 million at 3% interest. No taxes, no capital gains, no selling assets. You sold $200,000 in stock. You paid 20% capital gains tax on $150,000 in gains. $30,000 gone immediately. You're investing $170,000 after tax. They borrowed $200,000. They're investing the full amount. Their stocks continue compounding. They're paying $6,000 per year in interest, which is tax deductible. Your investment needs to outperform theirs by 15% just to break even after the tax hit you took. And here's the reality. If the market crashes, your stocks are sold and gone. Their stocks are still there, waiting to recover. They can ride out volatility. You locked in losses. The truth is harsher. Selling assets to access capital is what poor people do. Borrowing against assets to preserve compounding is what rich people do. Same need for liquidity, completely different wealth outcome. Strategy number 6, corporate debt structures. You start a business as a sole proprietor. You take out a $200,000 loan in your name to fund it. The business fails. You're personally liable for $200,000. Rich people never put personal assets at risk. They create an LLC or corporation. The business borrows $200,000. The business fails. The debt dies with the business. Their personal assets are untouchable. You're on the hook for everything. Your house, your savings, your future income, all at risk. Rich people understand that businesses fail. That's expected. What's not acceptable is letting business failure destroy personal wealth. And here's where it compounds. Because their personal credit isn't tied to business debt, they can fail 3 businesses and still have perfect personal credit to buy real estate, invest, and live comfortably. You fail one business, and your credit is destroyed for 7 years. You can't get a mortgage, you can't get favorable loan rates. One failure sets you back a decade. They're using the same debt you are, but the structure protects them while exposing you. You're playing the same game with different rules, and you don't even know it. Strategy number 7, debt-to-income engineering. You make $100,000 per year. You think you can borrow maybe $400,000 for a mortgage. Rich people making the same $100,000 can borrow $2 million. They understand that lenders care about debt-to-income ratio, not just income. So they engineer their income to maximize borrowing power. They pay themselves minimally from their business. They take income as dividends or distributions that don't count against debt-to-income the same way. They show losses on paper through depreciation while cash flowing positively. You're taking a W-2 salary. Every dollar you earn counts against you when calculating how much debt you can carry. The math tells a different story. You make $100,000 W-2. Lenders see $100,000 income. They'll lend you 4 to 5 times that. They make $100,000, but structure it as $40,000 salary and $60,000 in capital gains or dividends. Lenders weight different income types differently. They qualify for more debt on the same actual income. More borrowing power means more leverage. More leverage means more wealth accumulation. You're limited by how you structure your income. They're maximized because they understand the game. Strategy number 8, estate planning with strategic debt. You're 70 years old with $5 million in assets. You want to pass wealth to your kids, so you're trying to pay off all debt before you die. Rich people do the opposite. They die with maximum debt. When you die, your heirs get a stepped-up basis on inherited assets. That means no capital gains tax on appreciation that happened during your lifetime. If you own a $3 million property with a $1 million mortgage, your heirs inherit it at the $3 million value. They can sell it immediately, pay off the $1 million mortgage, and pocket $2 million tax-free. If you paid off the mortgage before dying, they inherit a $3 million property free and clear. Sounds better, right? But here's the problem. You spent $1 million paying off that mortgage. That's $1 million that didn't compound in investments for your last 10 to 15 years of life. That $1 million at 8% annual return for 15 years becomes $3.2 million. You gave up $2.2 million in growth to pay off debt that disappears at death anyway. They kept the mortgage, invested the cash, and died wealthier. Their heirs got more. The bank got paid from the estate. You optimized to die debt-free. They optimized to die wealthy. Different goals, different outcomes. Strategy number 9. Refinancing to pull equity without selling. You bought a property for $300,000. It's now worth $600,000. You're sitting on $300,000 in equity. You're proud of it. Rich people refinance and pull that equity out tax-free. They refinance at the new $600,000 value. They pull out $200,000 in cash. No taxes because it's a loan, not income. They invest that $200,000 into another property or business. Now they own 2 appreciating assets instead of 1. You're letting $300,000 sit dormant in a house, compounding at the rate of real estate appreciation, maybe 4 to 5% annually. They pulled equity and invested it at 10 to 12%. They're compounding faster on the same equity. Your $300,000 equity grows to $488,000 in 10 years at 5%. Their $200,000 pulled and invested grows to $518,000 at 10%. They made more money on less equity because they deployed it. The property they pulled equity from? Still appreciating. They didn't sell it. They just unlocked dormant capital. The truth is messier. Equity sitting in a property isn't working for you. It's dead capital. They keep it alive by continuously extracting and redeploying it. Strategy number 10. Using inflation to erode debt value over time. You borrow $500,000 at 4% interest. You're stressed about paying it back. You make extra payments to get rid of it faster. Rich people borrow $500,000 at 4% and pay the minimum for 30 years. Inflation erodes the real value of debt over time. That $500,000 you owe today is worth significantly less in 20 years. At 3% annual inflation, $500,000 in today's dollars is worth about $276,000 in 20 years. You're paying back money that's worth half what it was when you borrowed it. You're rushing to pay off debt with today's valuable dollars. They're slow paying with tomorrow's cheaper dollars. While you're dumping extra cash into debt payoff, they're investing that cash. Your net worth grows slower because you're paying down debt. Their net worth grows faster because they're compounding investments. The math tells a different story. You pay off $500,000 in debt over 15 years by making extra payments. You're debt-free. You feel great. They pay the minimum for 30 years, invest the difference, and end up with $800,000 in investments while still owing $200,000 on a loan that's now worth $110,000 in real terms. Net worth? Yours is $0, debt-free. Theirs is $600,000, $800,000 in assets minus $200,000 in debt. You won the feelings game. They won the wealth game.